All right, dear students and scholars, we are now moving into the practice stage. This is where ASC 340 becomes a working answer, not just a definition. In this video, we will handle 8 treatment based MCQs, 3 short answer applications, 1 integrated mini case, a compact IFRS and SAP bridge, and a final revision board. Every question is asking the same practical accounting question. Is this an asset, an expense, a measurement issue, an amortization issue, an impairment issue, or a reporting effect? Before we begin the questions, let us lock the decision discipline. First, identify the cost family: prepaid, pre production, insurance deposit, cost to obtain, or cost to fulfill. Second, check whether another ASC topic controls before applying ASC 340. Third, decide whether the item is an asset or an expense. Fourth, if capitalized, measure it and amortize it over the benefit pattern. Fifth, test impairment when required. Most mistakes happen because a cost is sent to the wrong accounting bucket before measurement even begins. Accounting buckets are like airport gates. If you enter the wrong gate, the whole journey goes somewhere else. For MCQ 1, Novadata pays $36,000 on March 1st, 2026 for 12 months of system support. The question asks for proper reporting at June 30th, 2026. Read the dates carefully. The support period begins on March 1st, and by June 30th, March, April, May, and June have passed. Choose the answer that reflects the benefit consumed and the remaining prepaid asset. Take a moment and lock your answer before moving to the explanation. The correct answer is option B. 4 months have passed, so expense equals $36,000 divided by 12 months multiplied by 4 months, which gives $12,000. The remaining prepaid asset is $24,000. Option A is wrong because the full amount is not consumed on day 1. Option C is wrong because it counts only 3 months, but March through June is 4 months. Option D is wrong because expense cannot wait until the contract ends. At June 30th, Novadata reports prepaid asset of $24,000 on the balance sheet and support expense of $12,000 on the income statement. For MCQ 2, a supplier incurs $90,000 designing a product for a long term supply arrangement, and there is no enforceable reimbursement guarantee. The question asks for the usual treatment. Focus on the key facts. It is a design cost, it relates to a long term supply arrangement, and there is no enforceable reimbursement right. Think through whether this cost creates a recognized asset under ASC 34010 or whether it must be expensed as incurred. The correct answer is option C, expense as incurred. Product design and development costs under a supply arrangement are expensed unless a qualifying exception applies, such as a legally enforceable reimbursement right. Option A is wrong because this is not a prepaid service right arising from a payment for future services. Option B is wrong because ASC 34040 contract cost rules do not override the specific pre-production guidance in ASC 34010. Option D is wrong because deferring until first shipment is not the model. Expected future revenue does not automatically create an asset. That is a common exam trap. For MCQ 3, the supplier spends $160,000 on production molds in 2027. The supplier owns the molds, will use them for a 5-year supply contract, and the molds do not involve new technology. The question asks for the likely treatment. Here, ownership and future production benefit are critical. Also, notice what is not present: no new technology and no customer ownership problem. Choose the answer that best reflects the asset created by the supplier owned molds. The correct answer is option B. Supplier owned molds used in production under a long term supply arrangement can be capitalized as tooling assets, with recoverability assessed when impairment indicators exist. Option A is wrong because production molds are not ordinary selling costs. Option C is wrong because the tooling cost is not a revenue deduction or customer price adjustment. Option D is wrong because deposit liability treatment belongs to insurance arrangements without risk transfer, not production tooling. The reporting effect is that the molds are shown as tooling or a related long lived asset, not as prepaid expense. For MCQ 4, a short duration insurance contract transfers neither significant timing risk nor significant underwriting risk. The question asks which accounting model should be considered. This is not a normal premium revenue question. The missing risk transfer changes the accounting. Focus on the two missing conditions: no significant timing risk and no significant underwriting risk. Select the answer that reflects the substance of an insurance or reinsurance arrangement without genuine insurance risk transfer. The correct answer is option B. Deposit accounting applies when neither significant timing risk nor significant underwriting risk transfers. The balance sheet carries a deposit asset or liability, and income recognition is delayed until the outcome can be reasonably estimated. Option A is wrong because immediate premium revenue requires risk transfer. Option C is wrong because OCI is not part of the deposit accounting model here. Option D is wrong because inventory financing is unrelated. The reporting effect is important. The deposit position stays on the balance sheet and income recognition waits for estimability. For MCQ 5, Bright Sub signs a 3-year customer contract on January 1st, 2027. A $30,000 sales commission is payable only because the contract was obtained and the cost is expected to be recovered. The facts are pointing toward the cost to obtain model under ASC 34040. Ask yourself two questions. Is the cost incremental and is it recoverable? Choose the treatment that follows from those two conditions. The correct answer is option A. The commission is incremental because it exists only because the contract was obtained, and it is recoverable, so it is capitalized as a contract cost asset and amortized over the expected benefit period. Option B is wrong because ASC 34040 does not say all commissions are automatically period costs. Option C is wrong because inventory is for goods held for sale, not a sales commission. Option D is wrong because a contract liability is an obligation to transfer goods or services to a customer. The entry is debit contract cost asset $30,000 and credit cash or payable $30,000. For MCQ 6, we are testing non-incremental cost traps. The question asks which cost is least likely to qualify as an incremental cost to obtain a customer contract. The central test is simple. Would the cost exist without the signed contract? Read each option with that test in mind. A cost may help the sales process and still fail the incremental test if it would have been incurred whether the customer signed or not. The correct answer is option C. Legal due diligence cost incurred whether the bid succeeds or fails is not incremental because it exists regardless of the contract outcome. Option A is wrong because a commission payable only when the contract is signed is incremental by design. Option B is wrong because a manager override commission tied to a specific obtained contract may qualify depending on the facts. Option D is wrong because a recoverable success fee payable only on contract award may qualify if recovery is expected. The exam trap is clear. Helping the sale is not enough. The cost must exist because the contract was obtained. For MCQ 7, the question asks which combination is required before a fulfillment cost can be capitalized under ASC 34040 when no other standard applies. This is the three-part fulfillment cost test. All three criteria must be met at the same time. Do not choose an option just because it contains business words like material, approved, or disclosed. The correct answer must connect directly to contract relation, future resource benefit, and recoverability. The correct answer is option B. A fulfillment cost must directly relate to a specific contract or specifically anticipated contract, create or enhance resources used to satisfy future performance obligations, and be expected to be recovered. Option A is wrong because cash payment, approval, and materiality are not the recognition test. Option C is wrong because costs tied to past performance are expensed as incurred. Option D is wrong because billing pattern and disclosure do not create an asset. If any one part of the three-part test fails, the cost is expensed unless another ASC topic requires a different treatment. For MCQ 8, we have an impairment calculation. A contract cost asset has a carrying amount of $90,000. Remaining expected consideration is $140,000. Direct remaining costs not yet expensed are $70,000. The formula is recoverable amount equals remaining consideration minus remaining direct costs. Then impairment loss equals carrying amount minus recoverable amount, but only if the result is positive. Word the numbers carefully before choosing your answer. The correct answer is option B, $20,000. First, calculate recoverable amount. $140,000 minus $70,000 equals $70,000. Then compare that with the carrying amount of $90,000. The carrying amount exceeds recoverable amount by $20,000. So the impairment loss is $20,000. Option A is wrong because recoverability is below carrying amount. Option C is wrong because it subtracts the wrong component. Option D is wrong because it confuses remaining direct costs with impairment loss. The entry is debit impairment loss $20,000 and credit contract cost asset $20,000. Now we move to the short answer set. These questions are designed to test whether you can explain the accounting treatment in words, not just select an option. Question 1 asks you to explain prepaid insurance paid on January 1st, 2026 for 1 year. Question 2 asks you to distinguish a contract acquisition commission from travel and bid costs. Question 3 asks you to explain deposit accounting when an insurance contract does not transfer significant insurance risk. For each answer, focus on recognition, measurement, financial statement effect, and a journal entry where useful. Here are the model points. For prepaid insurance, record a prepaid asset for the full cash payment on January 1st. Then reduce the prepaid asset each month and recognize insurance expense for 1/12 of the annual premium. By December 31st, the prepaid balance is zero. For commission versus travel and bid costs, a recoverable commission paid only because the contract is obtained may be capitalized, while travel and bid costs are usually expensed because they are incurred whether or not the contract is awarded. For deposit accounting, no significant risk transfer means normal premium timing is replaced by a deposit asset or liability, and income recognition is deferred until reasonably estimable. Now let us walk through the integrated mini case. SecureCloud signs a 5-year monitoring contract on January 1st, 2028. The company has a $50,000 recoverable sales commission payable only because the contract was obtained, a $120,000 fixed sales salary paid regardless of contracts, $80,000 of setup labor for future service delivery, $40,000 of dedicated hardware installed at the customer site, and $15,000 of abnormal rework. Your task is to decide asset or expense, record the initial entries, determine amortization for capitalized items, and identify the financial statement effect. The solution follows classification first. The $50,000 sales commission is capitalized as a contract cost asset. The $120,000 fixed sales salary is expensed as incurred. The $80,000 setup labor is capitalized as a contract fulfillment asset if all three criteria are met. The $40,000 hardware is evaluated under ASC 360, not forced into ASC 340. The $15,000 abnormal rework is expensed. The entries are debit contract cost asset $50,000 and credit cash or payable $50,000, debit contract fulfillment asset $80,000 and credit cash or payables $80,000, and debit selling and rework expense $135,000 and credit cash or payables $135,000. The qualifying assets are amortized over the 5-year benefit pattern with impairment testing when indicators arise. Let us add the comparison bridge. Under IFRS 15, contract cost recognition is broadly aligned with ASC 340. Both frameworks require incremental costs of obtaining a contract to be capitalized if recovery is expected, and both use a similar fulfillment cost test. Differences arise around impairment. IFRS uses cash generating unit logic in later impairment analysis and may permit reversal under certain conditions. Under US GAAP, reversal of a previously recognized ASC 340 contract cost impairment is not permitted. For SAP, the statutory accounting point is especially important for insurers. SSAP number 71 expenses, policy acquisition costs, and commissions as incurred. So, statutory reporting can be much more conservative in early policy years. Here is the final memory board for ASC 340. Prepaids are assets first, then expense over the benefit period. Pre-production costs are expensed by default unless a supplier-owned tool or enforceable reimbursement right supports asset treatment. No risk insurance uses deposit, asset, or liability accounting. Contract obtained costs are capitalized only when incremental and recoverable. Contract fulfill costs require all three criteria: direct relation to the contract, future resource benefit, and expected recovery. Contract cost assets are amortized with the benefit pattern and tested for impairment when indicators arise. ASC 340 is now complete. Thank you for studying with me. If this practice session helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who want clear and practical US GAAP learning.